Have you ever wondered why you're not getting much back at tax time? Most Canadians are unknowingly overpaying their taxes every single year. But here's the good news. It's 100% legal to avoid it. You just need to know the right strategies. After 11 years as a financial advisor and hundreds of hours studying this topic, I'm sharing the top strategies to help you pay less in taxes and keep more of your hard-earned money. Now let's dive in. Hey, if you're new here, my name is Darcy Bell, and I'm a certified financial planner with IG Wealth Management. I help Canadians just like you get their finances on track and unlock the full potential of their income. Number one, misconception: how taxes work. A common question I hear is, should I avoid a pay raise because it might bump me into a higher tax bracket? This is one of the biggest misconceptions about Canada's tax system. Here's the truth. Canada has a progressive tax system. Yes, the more you earn, the higher your marginal tax rate, but that higher rate only applies to the portion of income above each tax bracket threshold. For example, if you earn $70,000 in Alberta, your income isn't taxed all at the highest rate. Canada's tax system works like a staircase. Each step represents a tax bracket, and only the portion of your income that falls into each step is taxed at that specific rate. Here's how it works in Alberta. The first step, income up to $57,375, is taxed at a combined federal and provincial rate of 25%. The next step, income from $57,376 to $70,000, is taxed at 30.5%. So if you earn $70,000, here's how your taxes are calculated. On the first $57,375, you'll pay $14,343.75, 25%. On the remaining $12,625, you'll pay $38.50 at 30.5%. This brings your total tax bill to $18,194. Your effective tax rate, the average percent of tax you pay on your total income, is closer to 26%, not the highest marginal rate of 30.5%. Now this is simplified a little bit here and ignores some tax credits, most notably the basic personal exemption. But you get the idea. The higher tax rate only applies to the income that exceeds each threshold, not your entire income. Think of it as climbing a staircase. You only pay the higher rate on the higher steps. Why you get a tax refund or why you don't? Many Canadians assume their tax refund is free money from the government. That's not true. Here's what actually happens. Your employer withholds a portion of your income for taxes throughout the year and sends it to the government. To be safe, they often withhold more than needed, leading to a refund after you file for your tax. If you're working multiple jobs, it's common to owe taxes instead of getting a refund. Why? Each employer assumes you're entitled to the basic personal exemption, which reduces taxes owed. But if both employers apply it, you end up underpaying. And don't forget, any additional income from side hustles or investments often has no taxes withheld, which could lead to unexpected tax bills. The power of registered accounts. If you want to lower your taxable income and save money, registered accounts are your best friend. Here are 3 key ones to know. Group RRSPs. This is for your workplace. Contributions to a group RRSP lower your taxable income directly. For example, if you earn $100,000 and contribute $10,000 to your RRSP, your taxable income becomes $90,000. Many employers offer matching contributions, where every dollar you save is matched by them. This is essentially free money. Don't miss out. Number 2, personal RRSPs. If your workplace doesn't offer an RRSP, you can open one yourself. You can contribute up to 18% of your previous year's income, up to a maximum dollar limit of $32,490, with unused room carrying forward indefinitely. Like group RRSPs, contributions lower your taxable income, and the funds grow tax deferred until withdrawal. Number 3, first home savings account. Designed for first-time home buyers, this account combines the benefits of an RRSP and a TFSA. Contributions provide a tax deduction, and withdrawals for your first home are completely tax-free, with no repayment required. Being self-employed. If you're self-employed, there are unique opportunities to save on taxes. Here are some of the key benefits. Write off business expenses. You can deduct costs like advertising, office supplies, travel, and even a portion of your home expenses if you have a home office. For example, if you earned $100,000 but had $20,000 of business expenses, your taxable income drops to $80,000. Number 2, CPP contributions. Unlike employees who split CPP payments with their employer, self-employed individuals pay both portions. While this is higher, it opens up more opportunities to control your taxable income through deductions and credits. Number 3, home office expenses. Self-employed individuals can deduct a portion of mortgage interest, property taxes, and home insurance, something employees generally cannot do. Tax deductions and credits to remember. There are many ways to reduce your taxes, but here are 2 of the most impactful. Number 1, childcare expenses. Families where both spouses work can claim up to $8,000 per child under 7 and $5,000 for child age 7 to 16. Number 2, medical expense tax credit. You can claim eligible medical expenses if they exceed 3% of your net income. For couples combining all medical expenses under the lower income spouse often maximizes your tax savings. Income splitting strategies. If you're in a high income household, consider these strategies. Number 1, spousal RRSPs. The higher earning spouse contributes to a spousal RRSP, reducing their taxable income while the lower income spouse owns the account. This balances the taxable income during retirement. Number 2, spousal loans. A higher income spouse can loan money to a lower income spouse at the CRA's prescribed rate for investment purposes. The investment income is taxed in the lower income spouse's hands, reducing overall family taxes. These are just a few of the strategies that can help you save thousands on taxes every year. The key is knowing which tools and accounts work best for your unique situation. If you want personalized advice on how to maximize your tax savings, let's talk. Click the link in the description to book a free consultation with me. Together, we'll build a strategy that helps you keep more of your hard-earned money. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share it with others. I'll see you in the next video.